Bandhan Mutual Fund presents MF Corner.
Hello and welcome. You're tuned into this Mutual Fund YouTube Corner edition, and we are going to be discussing a whole host of things here. Let's welcome the expert first. Amol Joshi, founder of PlanRupee Investment Services, is joining us now. Amol, always a pleasure speaking with you, and we have spoken about a whole host of things. But today, let's talk about the fixed income space, because, you know, while there's a lot of money going into equity investments, this could be a time to look at fixed income as well. So let's break it down for the viewers as well. And let me start by asking you, with inflation remaining a little steady, there could be an interest rate cut this year. We still don't know when. Do you think this is the ideal time to look at fixed income funds?
Sonal, hi. You have touched upon very important point in the opening remarks itself. Lot of money is going to equities, and why not? Last 1 year, why not take 4 years? Markets have done substantially well. Having said that, let's come back to fixed income. There is no investor, no sane person should ignore the role of asset allocation or role of assets other than equity in building his or her portfolio. Now, what do I mean by that? You have today large cap and mid cap. We are talking, of course, about equity funds that have delivered in excess of 60 or 80% 1 year return, and there is a 3-year, 4-year CAGR of about 30 to 40%. Now, goes without saying that this invariably means that market valuations, both in absolute number terms as well as the historical valuations, are no longer cheap. And that is where you really have to look at fixed income by giving it a lot of importance. The biggest thing that fixed income does is not just asset allocation, is not just, having money for your shorter or near-term goals. Fixed income also gives a much-needed portfolio stability in case equity market becomes volatile. We saw that market volatility during global financial crisis way back in 2008. We saw that some of that crisis market volatility in 2016 during demonetization, and many other instances, not to forget the COVID. Where asset allocation plays a role, it's suppose you start with a 60-40 sort of an asset allocation. If the market does exceedingly well, like it has done for last few years, the asset allocation would now be skewed in favor of equity to 80-20. When the market crashes, you really will not have money to make entry at lower prices. And this is where your debt portfolio also can help you by redeeming the debt, going into equity, and benefiting from lower asset prices of equity. So very important, fixed income cannot be ignored. Very simple.
No, that makes absolute sense. So in that case, what are some of the things that an investor should look at, especially the retail investor when they're investing in fixed income funds? And what are some of the key hygiene aspects that you would like to tell us about?
Right. So in fixed income, you have something called as portfolio yield, or in more technical terms, you have something called as YTM. YTM stands for yield to maturity. So every debt portfolio has YTM, and this YTM figure is openly disclosed in monthly fact sheet. So every month you would know what kind of bonds that a fund is holding. The way equity mutual fund invests in stocks and shares, similarly debt mutual fund invests, to put it simply, debt securities, fixed income securities, or very simply bonds. Now you will know portfolio yield of every scheme in their monthly fact sheets. Now, as it may happen, and as anybody can guess, the highest rated securities, obviously, since they are highest rated, they are probably the safest AAA rated securities or sovereign securities. These debt securities offer you yields that are comparatively lower than a lower rated security. Obviously so. Why? Because lower rated security, AA, AA minus, or single A, these have lesser safety rating. So do not purely go by the YTM. If the YTM is higher of any particular scheme, that also means that this fund probably has exposure to debt securities that are lower rated on the safety scale. So do not purely look at YTM. That's certainly hygiene factor number one. Hygiene factor number two is, there are many examples. People want to pay off the school fees once in a year. People want to take their annual vacations. Now, all these goals, financial goals, are 6 months, 9 months, 12 months in nature. So for such goals, invest in a short-term fund or a low duration fund, and not necessarily invest in a longer maturity debt fund. These are some of the hygiene factors that you should look at when you are building your fixed income portfolio.
Okay, that's quite helpful. Amol, so how can a retail investor take exposure to fixed income funds? There's so many, it's confusing at times.
Sure. Yes, you're right. There are hundreds of schemes, if not more. What you can do is simply try to align the maturity of the fund with maturity of your goal or your requirement of money. As I mentioned in the previous part of my answer, if you need money that over next 6 months, then probably ultra short-term funds or low duration funds are the right choice. Although, as an asset allocation component, only for rebalancing purpose, if you are keeping some funds aside for a 5-year horizon, then you can certainly go towards another couple of categories of mutual funds. Now, what are those categories? In earlier years, there used to be a category called fixed income mutual fund, in the sense, or rather fixed maturity, I'm sorry, FMP, fixed maturity funds. Fixed maturity funds typically had a sort of maturity that is 3 years out or 5 years out. Now, 5 years later, you have any expense that is coming up, and because of asset allocation reasons, you want to invest that amount in mutual funds, then FMPs, but now those FMPs are mostly very few and far in between. You now have something called as a target maturity funds. So today, if you just open any platform, you will see a lot of funds that are maturing sometime in 2028. Some of them are maturing 2030. If you take exposure to these funds, you will get your money precisely around the same time that your financial goal needs you to have money. So these are some of the funds or some of the categories that you can use. Now, there are many people who also manage their credit card outstanding via mutual fund. How does that take place? Your salary is typically credited in early part of the month, say, let's say first of the month, and your credit card bill is due on 25th. So that money, the credit card bill, you also can invest in liquid funds. Liquid funds are suitable for anybody who wants to stay invested for 7 days only. So for 25 days also, instead of keeping money just in saving account and earns lower rate of return, you can invest probably in liquid funds and earn slightly better return. These are also part of habits, asset allocation, many things in the mix.
Okay, all right. That's a complete lowdown on the fixed income space. Of course, we can have a greater discussion and a longer discussion on that, but that is for some other time, Amol. Always a pleasure speaking with you. Thank you so much for joining us today.
Pleasure. Thanks.
Okay, all right. With that, we'll take your leave on this edition of Mutual Fund Corner YouTube edition, but we'll come back with more, so stay tuned for that.
Bandhan Mutual Fund presents MF Corner.